Sound check. Sound check. Sound check. Good afternoon, students. Okay, so let's get started now with our next lecture on your ratio analysis. So, welcome to this live batch, and we call this as a champions. Why champions batch? Because champions has certain characteristics. What are the main characteristics of champions? That they are always very disciplined, always very dedicated, and they believe in the preparation and the things what they do. So, my dear students, here today we are going to prepare in much better way for your financial management, and let's continue further and let's accept and adopt all these characteristics of champions, okay, and study everything very conceptually, also at the same time practice problems and make your financial management one of the most strongest subjects of your entire interc. Okay, so we are not going to settle for anything below 50 on 15 FM. So we have to study with that focus, with that dedication, with that discipline, and with that much enthusiasm, excitement. So, my dear students, today we are going to solve much level advanced questions of ratio analysis. Okay, so as you all are aware about the fact that we have completed all the ratios in all I've taught you, somewhere around 37 ratios. And in those 37 ratios, we completed your balance sheet ratios, your P&L ratios, your mixed ratios, and we also did some other important ratios, right? So when we were talking about your balance sheet ratios, we had in the numerator and the denominator balance sheet. In the P&L ratios, the numerator and denominator both were P&L. And in the mixed ratios, your numerator came from your P&L, your denominator came from balance sheet. And then we had in your mixed ratios something which was called as your turnover ratios and something which is called as your return ratios. So whenever we talk about your turnover ratios, there were 6 turnover ratios, 3 time period ratios which we did, and return ratios dealt with your return on capital employed, return on equity shareholders funds, return on shareholders funds, etc. Also, then we did something with regards to your other important ratios, in which we did EPS, dividend per share, retention ratio, payout ratio, book value per share, coverage ratio, PE ratio, everything. So each and every ratio which we did, my dear students, we did it conceptually by writing down the notes, understanding how does each and every element comes. And guys, our ratios, we did it fundamentally very strong. Then we started with the practical problems, and now we are left with some of the questions. So we are going to now complete that. Okay. So as you all are aware that how do we do this financial management? we take into consideration each and everything. We have to solve properly. You just don't have to see and watch the videos. You have to solve this along with you. Okay, so that is the most important thing. So whatever writing practice you need in financial management, I am going to give you. Okay. So now, my dear students, let us start now with your question number 11. Okay. So let's get started. In your 11th question, what is given to you? Manan Private Limited gives you the following information relating to the year ended 31st of March 2023. So what details do you have here? You have your current ratio, which is 2.5 is to 1. Then we have the debt equity ratio, which is 1 is to 1.5. We have return on total assets, that is nothing but 15%. We have total assets turnover ratio, which is available. We have gross profit ratio available. Then we have stock turnover ratio. After which we have net working capital, we have fixed assets, we have 1,80,000 equity shares of rupees 10 each. We have 60,000 9% preference shares of rupees 10 each. We also have the opening stock which is available. And here we are required to calculate what is going to be quick ratio, the fixed assets turnover ratio, the proprietaries ratio, and the earning per share. My dear students, we are required to calculate all these types of ratios, but in that particular case, let's say for example, we are talking about quick ratio. What is your quick ratio? Your quick ratio is nothing but quick assets upon quick liabilities. In that, we take into consideration current assets minus stock minus prepaid expenses upon current. But unfortunately, in this particular question, you don't have your current ratio readily available. You don't have the current assets readily available. You have the current ratio, but you don't have the current assets amount available. Now, in this particular case, my dear students, we cannot calculate the ratios until and unless we have the balance sheet, because only if we have the balance sheet available, we will come to know that these are the list of current assets, these are the list of current liabilities, and also at the same time we have some fixed assets available, so which will help you to calculate the ratio. See, I just don't want to teach you the question, but I want you to develop the thought process that whenever these kind of questions come, what should be your approach towards the question? That is very important. So while reading the question, you have understood, okay, fine, we are required to calculate these four ratios. But when I'm talking about the quick ratio, but we don't have any data available pertaining to your current assets. We don't have any data available pertaining to your current liabilities. So we just have this ratio available. So what we need to do is we have to prepare the balance sheet for the same. Only when we prepare the balance sheet, we will come to know, okay, fine. So this is the balance sheet. In this balance sheet, these are the figures, and then we can calculate these ratios. Okay. So here, my dear students, balance sheet is the most important thing, without which you cannot calculate these ratios. Okay. So go to your notebooks and now let us write it down. This is your solution now to question number 11. Okay. And we will write down balance sheet of Manan Limited, Manan Private Limited. So we can write down here Messrs. Manan Private Limited. And now this is actually going to be our working mode, right? Because we are required to calculate the ratios. Okay. So balance sheet of Messrs. Manan Private Limited as on what? 31st of March 2023. So now we can prepare this balance sheet. You can prepare this for approximately 15 lines. Okay. And as I've always told you, the first step is to prepare the face. What we need to do, we have to prepare the face. Okay. So I'll write down here liabilities, rupees, assets, rupees. We need to figure it out which all list of assets and liabilities are going to be there. So as you all can just check, we have something which is called, as you're on your balance sheet liabilities, that we have equity share capital. So we know all these items are going to be there. Equity share capital. Then we will be having reserves and surplus. After this, we'll be having something which is called as your equity shareholders funds, also known as your net worth. Oh, one second. Is there any preference shares in this question? Yes, sir. So first we need to write down the preference share capital as well. In this question, there is 60,000 9% preference shares. So we'll be writing down 9% preference share capital as well, where the total of this will be now called as your shareholders funds. Okay, so this will be called as your shareholders funds, which is also known as your owners funds and also known as your proprietors funds. Okay, students. So we'll be having equity share capital, reserves and surplus, 9% preference share capital, the total of which comes as your shareholders funds, owners funds or proprietors funds. After this, my dear students, what next do you have? So you have something which is called as your, just check, there is debt also which is available. So we have long-term debt. So there is going to be long-term debt. After which we have your current liabilities. So there is current liabilities. And here on the asset side, definitely we'll be having fixed assets. After your amount of fixed assets, we have uh, your current assets. But do we have the breakup of the current assets? Have they told you there is a debt collection period or something like that? No, but at least there is a current ratio and we are required to calculate the quick ratio. So definitely there is going to be stock as well. So I'll just write down your stock and this will be your other current assets. Not required though, but still whatever breakup is possible, I'm taking that into consideration. Okay. Now, my dear students, this is your balance sheet. Okay. What do we have here? First of all, we have equity share capital, which is 1,80,000 shares of rupees 10 each. So we can write down 18 lakhs as your equity share capital. Then also at the same time, we have 60,000 9% preference shares of rupees 10 each. So that's going to be 6 lakhs. Then what do we have? We have next fixed assets amounting to rupees 30 lakhs. After which we have, now you have your net working capital, which is 13,50,000. Now we have the working capital amount available and we also have the current ratio available. Students, if we have the working capital amount available as well as if we have the current ratio available, are we in the position to now calculate your current assets and current liabilities? Come on, yes or no? Of course, yes. So we are in the position to calculate your current assets and current liabilities. So now, my dear students, if I write down your working note number 1, okay, where I'll write down calculation of current assets and current liabilities. So all these things are possible with the help of the working capital which is given. See guys, we have the working capital amount which is 13,50,000 and we have the current ratio is 2.5. So I'll put it like this. Current ratio is current assets upon your current liabilities, which is actually 2.5 is to 1. Now, what's the formula for your working capital? Can I say working capital formula is nothing but CA minus CL. So, do we have the amount of your current assets? Do we have this ratio? Yes, this is 2.5. This is 1. So, working capital will become 1.5. Now, what is the amount of working capital which I have? The amount of working capital which I actually have is 13,50,000. So, will this give me a position to calculate my current assets? Yes, sir. So, what's my current assets going to be? My current assets will be 13,50,000 into 2.5. Divide that by 1.5. So, that is going to come as 22,50,000. And students, when I have 22,50,000, from this, if you subtract current liability 13,50,000, working capital 13,50,000, I'll be getting my current liability, which is 9 lakhs. So now, do I have my current assets and current liabilities available? Come on, yes or no? Yes, sir. I have my current assets, which turns out to be 22,50,000, and I have my current liabilities, which is rupees 9 lakhs. So I can now write down current assets, which is 22,50,000. And then, my dear students, I have my current liabilities, which is 9 lakhs. And this comes from your working note number 1. Never forget to give the reference from where these figures are coming. Okay. So current ratio 2.5:1. So we took that into consideration. What is going to be your CA and your CL. Also at the same time, your fixed assets, we have already written that. Net working capital, we have taken use of that. Equity share preferences and your opening stock. Opening stock, my dear students, we will take into consideration when we'll be doing stock turnover ratio. Okay, so at that time, we'll be taking that into consideration because stock turnover ratio is your COGS upon average stock and stuff like that. So that's why we'll keep it as it is. Now, my dear students, which ratio should I start with? So as you all can see, there is debt equity ratio. Okay. Now, when I'm talking about debt equity ratio, you must be wondering, okay, sir, we neither have debt, neither we have equity shareholders funds. It's okay, no problem. Still, we can do this. How? Because see, we have fixed assets, we have current assets. The total of this will now become what? 52 lakh 50,000. So this will also become 52 lakh 50,000. Okay. Now, my dear students, can I say if 52 lakh 50,000 is my total of liability side and my current liabilities appears to be 9 lakh rupees. So from 52 lakh 50, if my current liability appears to be 9 lakh rupees, automatically your balance proportion, will it be treated as your shareholders funds, which is balance proportion, will it be treated as your capital employed? Come on, yes or no? Yes, sir, because capital employed will be shareholder funds plus the amount of the long-term debt. Put both together, we'll be getting something which is called as your capital employed. So now, my dear students, do we have the position to calculate the capital employed? Yes or no? Yes. We can calculate capital employed. And how are we going to do this? Okay. So we can write down here solution to the second part, and that will be calculation of capital employed and debt and equity. Okay. Now, what's my total of assets side? So as you all are aware, my total of assets appears to be 52 lakh 50. Okay. That's how my total of liabilities is also nothing but 52 lakh 50. Okay. Now, what does your total of liability consist of? So it consists of your shareholder funds plus your borrowed funds plus your current liabilities, which is nothing but 52 lakh 50. Correct? So shareholder funds plus borrowed funds plus current liabilities, that all put together will give you total of the liability side, which is 52 lakh 50. Now, do I have the amount of the current liability available? Yes, sir. How much is that? 9 lakhs. So shareholder funds plus borrowed funds, that will be 52 lakh 50 minus I'll be subtracting the current liability, that is 9 lakhs. Okay. So therefore, shareholder funds plus borrowed funds will now appear to be how much? 52 lakh 50 minus 9 lakhs. So that's going to be 43 lakh 50. Now, does this 43 lakh 50, my dear students, it has capital employed as well as your it will have your shareholders funds as well as your borrowed funds. Come on, yes or no? Yes, sir. And that's going to be together 43 lakh 50,000. Now, when I have my total capital employed as 43 lakh 50,000, can I use my debt equity ratio for the purpose of calculating what is going to be the quantum of debt and what's going to be the quantum of equity? Come on, yes or no? Of course, yes, I can take that into consideration. So as you all can see, we have the debt equity ratio, that is 1:1.5. Now, my dear students, your shareholder funds is actually the combination of equity share capital, right, plus reserves and surplus, right, plus preference share capital, plus borrowed funds. This together is nothing but 43 lakh 50. Okay. Now, in this, I already have my preference share capital amount available. What is the amount of the preference share capital which is available? As you all can just check, my amount of preference share capital is nothing but 6 lakhs. Okay. So this amount is nothing but 6 lakhs. So therefore, can I say equity share capital plus reserves and surplus plus borrowed funds, that will be equal to 43 lakh 50 minus 6 lakh rupees. So which turns out to be how much? 37 lakh 50,000. So this is nothing but equity shareholder funds plus borrowed funds, that is 37 lakh 50,000. So have you understood? In your debt equity ratio, your equity stands for your equity shareholder funds. Your equity stands for your equity shareholders funds, and this was something which we discussed when we were revising, when we are doing the ratios. And in the balance sheet ratios, in the debt equity ratio, we have understood that the word equity actually stands for your what? It stands for your equity shareholder funds. Now, when it stands for your equity shareholders funds, can I say it is nothing but equity share capital plus your reserves and surplus, right? This is nothing but your equity shareholders funds, right? Now, if I have the debt equity ratio available, can I calculate what should be your equity shareholders funds and what is going to be the amount of the debt? Very much possible. How will I do this? Because see, your debt equity ratio is nothing but 1 is to 1.5. So this is 1 upon 1.5. So can I put it like this? Your equity is 1.5 plus debt is 1. So this is nothing but 2.5 because debt is 1, equity is 1.5. So I'm taking equity shareholders funds 1.5, I'm taking borrowed funds as 1. So this together will now become 2.5. And now this 2.5 amount, do I have available as 37 lakh 50,000? Yes or no? Yes. So now I can cross multiply it and I can calculate. So you have to first understand that when we talk about debt equity ratio, ICAI considers debt equity ratio as what? Debt upon equity shareholders funds. Very simple. So what did I do first? I first calculated what is debt plus equity shareholders funds total amount. And I have the ratio available. Then can I say I can substitute the ratio and get the amount and answer available, right? So as you all can check, see your shareholder funds plus borrowed funds plus current liabilities 52 lakh 50. I started with this. I started with breakup of the total liability side. When I understood that I have amount of current liability available. So I know shareholder fund plus borrowed funds is nothing but my 43 lakh 50,000. But I have debt equity ratio available. But no worries, I also have the amount of preference share capital. Now, when I have the amount of the preference share capital, what I'm going to do? I will be simply taking into consideration equity share capital plus reserves plus preference share capital plus borrowed funds 48 lakh 50. And this amount I've substituted, which is 6 lakh rupees. So now I'm left with equity shareholder fund plus borrowed funds, that is 3750. And then if 3750 amount is 2.5, so what should be the amount of equity shareholders funds? You can simply cross multiply and now we can get the equity shareholders funds also and we can also get the borrowed funds. Okay. So let's get started now. What will be your equity shareholders fund? So if 37 lakh 50 is 2.5, so 1.5 is how much? We can cross multiply this. So this is now going to be equity shareholder funds. What will be the amount for the same? That will be 37 lakh 50 into 1.5, divide that by 2.5. So what is this going to be? 22 lakh 50,000. So now my equity shareholders funds is 22 lakh 50,000. And what is the amount of my debt? So my amount of the debt is going to be 15 lakhs. So are we in the position to now substitute all these things on your balance sheet liability side? Come on, yes or no? Yes, sir. My equity shareholders funds is 22 lakh 50. And my long-term debt, equity shareholder funds is 22 lakh 50. So if this two combined is 22 lakh 50, then my reserves and surplus will be 4 lakh 50. Got it? Obviously, because equity share capital plus reserves and surplus together constitutes equity shareholder funds. And your equity shareholder funds amount is 22 lakh 50,000. If I have the amount of equity share capital, don't you think reserves and surplus will become my balance sheet? Okay. And then my long-term debt appears to be 15 lakhs. So this is now 22 lakh 50 plus 6 lakhs, which is nothing but 28 lakh 50. Now to this 28 lakh 50,000, can I add long-term debt? Yes, sir, which will be 15 lakhs. Can I add current liabilities? Yes, which is going to be 9 lakhs. So that together will now give me 52 lakh 50,000. So in this way, have we created the entire breakup of the liability side? Come on, yes or no? Of course, yes, sir. So we are going to deal with what is going to be equity share capital, reserves and surplus, 9% preference shares, long-term debt, current liabilities, that together total liabilities. We have total assets also available now. So if I get the amount of the stock and based on that, I can definitely complete this and calculate the other ratios as well. Now, what do we have next? Okay, we have something which is called as return on total assets. Okay, let's use this. Total asset turnover ratio is 2 times. Okay, now I have the assets available. Okay, and I also have the total asset turnover ratio available, which can help me to actually calculate the amount of sales. Also, if I want to calculate return on total assets, now what will be the formula for return on total assets, guys? Return on total assets. So we have to calculate how much returns are we generating on the total assets. So your returns is nothing but your profits, and let that divide that by the total assets. But this profit should be before tax or after tax. This should be after tax. So now, my dear students, your working note number 3 will be return on total assets, which will be NPAT upon total assets into 100. So what's the amount of the N? Let's check that out. Your amount of the NPAT, we need to find out where we have the return on total assets, which appears to be 15%. So this is 15. Let this be X, and we have the total of the asset side, which comes out to be how much? 52 lakh 50,000. Okay, so we have this as 52 lakh 50. So can we get the amount of the NPAT available? Yes, sir. So what's your amount of NPAT? So that will be 52 lakh 50 into 15. Divide that by 100. So that is 7 lakh 87,500. So this is the NPAT available. Now you are like, sir, why do we require NPAT? Might be in some of the ratios which we have to calculate. Maybe in that particular case, NPAT might be required. So we are just taking this into consideration. Okay. Then, my dear students, we have total asset turnover ratio. So now let us write down fourth part, total asset turnover ratio. Now what's going to be the formula for total asset turnover ratio? So this is nothing but sales upon total assets. And what is this ratio? This ratio is given to you as 2 times. So this should be 2 is equal to, let the sales be X, and your total assets is 52 lakh 50,000. So are we in the position to calculate the amount of the sales? Of course, yes, we can calculate the sales. And that will be now 52 lakh 50 into 2 times. So this will be 1 crore 5 lakhs. So now I also have the amount of the sales, which is nothing but 1 crore 5 lakhs. What am I going to do with this 1 crore 5 lakhs, which is the amount of the sales? So at present in the balance sheet, so there is not going to be any impact of the same. We will see what other things can be calculated. So your return on total assets is done. Then we can use GP ratio. So we are going to now have fifth GP ratio. What is going to be your GP ratio? As you all know, the formula for GP ratio is gross profits upon sales into 100. So in this particular case, we have the GP ratio as 20%. So obviously sales into 20% will now give me GP. So my sales is 1 crore 5 lakhs. If I multiply that by 20%, that will be nothing but 21 lakhs. So now do I have the amount of the gross profit, which is nothing but 21 lakhs? Come on, yes or no? Yes, sir. And then they have told you there is stock turnover ratio. Okay, fine, no problem. Now I will use stock turnover ratio. What's the formula for stock turnover ratio? That's nothing but COGS by average stock, right? This is what I've taught you, COGS by average stock. But in some questions, as I told you, that when the COGS is not available, or when they specifically tell you those situations, we are going to take into consideration sales, okay? Or else it's going to be COGS upon average stock. Now, my dear students, are we having your COGS? Yes, we can calculate that COGS. How will we calculate it? Sales minus GP. That will give you COGS. And average stock. Okay, first let us write down like this only, average stock. What's the amount of the sales? Your amount of the sales is 1 crore 5 lakhs. What's the amount of the GP? That's nothing but 21 lakhs. And let me divide this by average stock. Okay, ultimately our aim is to calculate your closing stock. And closing stock, we will be able to calculate it because we have the opening stock available. So first, let us calculate the average stock. And then, my dear students, once we get the average stock, we have the opening stock available. Can I say your balancing part will be your closing stock? So on that basis, we can calculate it. Okay. So this stock turnover ratio is nothing but 7 times. So this is a 7 times. So what is going to be your average stock? your average stock will now be 1 crore 5 lakhs minus 21 lakhs, and that is something which you're going to divide by 7. So that appears to be 12 lakh rupees. Now, as you all are aware, what is average stock? Your average stock is nothing but opening stock plus closing stock divided by 2, right? So opening plus closing divided by 2, that is nothing but 12 lakhs. Now, in the balance sheet, which stock is going to go? Of course, in the balance sheet, your closing stock is going to go. So do we have the amount of the opening stock? Come on, yes or no? Yes, sir. We have the amount of the opening stock, which is 11 lakh 40,000. So I have this opening stock as 11 lakh 40. Let the closing stock be X. Divide that by 2 is 12 lakh rupees. So now let's calculate what is going to be the amount of the closing stock. So now this is going to be 24 lakhs, from which I'll be subtracting 11 lakh 40,000, which will now give me 12 lakh 60. So is 12 lakh 60 going to be my closing stock? Come on, yes or no? Yes, sir. What will I do with this 12 lakh 60? I can go and I can substitute in my balance sheet 12 lakh 60,000. So now I have the stock, which is 12 lakh 60. Dear students, now can I calculate the other current assets? Yes, sir. From this, if I subtract 22 lakh 50, what I get is 9 lakh 90,000. So this is how we are going to prepare your entire balance sheet. We are going to prepare the entire balance sheet just like this. Okay. And because the balance sheet is now available, we are in the position to now calculate different types of ratios. So now can we calculate the ratios? Come on, yes or no? Yes, sir. See, the first ratio which we have is your quick ratio. So now we are having quick ratio. So I can now write it down here. Now these are your final answers. Okay. So in your answers, the first thing we are going to write down here is your A, which will be your quick ratio. So what's the formula for your quick ratio? Can I say your quick ratio is nothing but from your quick assets, we will be subtracting quick liabilities. So what are your quick assets? So from current assets, we subtract your stock, we subtract prepaid expenses, and then we divide that by current liabilities. So do we have the current assets total? Yes, sir, we do have current assets total. What's the amount of the current assets? We have your current assets, which is nothing but 22 lakh 50, and the amount of the stock is 12 lakh 60, and your current liabilities is 9. So from your 22 lakh 50, now I will subtract 12 lakh 60, and my prepaid expenses is 0, and this I'm going to divide by 9. So this will now be 22 lakh 50 minus 12 lakh 60, which I will be dividing it by 9 lakhs. So this will now be 1.1 is to 1. So now do I have the quick ratio available? Come on, yes or no? Yes, sir. I do have the quick ratio, which is 1.1 is to 1. Next, we have fixed assets turnover ratio. Okay, so B part, we have fixed assets turnover ratio. Now, how will we calculate your fixed assets turnover ratio? As you all know, what's the formula? Sales upon average fixed assets. But we don't have the opening, so we are going to simply divide that by our closing fixed assets. Come on, guys, we know this. Fixed asset turnover ratio is nothing but your sales upon fixed assets. Do we have the amount of the sales available? Yes, sir. What's the amount of the sales? The amount of the sales is 1 crore 5 lakhs. Okay. And what's the amount of the fixed assets which we have? So we have the amount of the fixed assets, which appears to be 30 lakhs. So this is 30 lakhs. So now, my dear students, what will be this fixed assets turnover ratio? 3.5 times. And then, my dear students, what is the next ratio? Your next ratio is proprietary ratio. Okay, fine, no problem. Proprietary ratio. What will be the formula for this proprietary ratio? So proprietary ratio, my dear students, we can simply take into consideration your fixed assets and divide that by proprietary funds. Because here in this particular ratio, what do we check? We check that on 1 rupee of the proprietor's money, what is the amount which is blocked in the fixed assets? So basically the whole idea is to actually check that 1 rupee from owner's funds, how much is invested in your fixed assets. So that's how we calculate the proprietary ratio. Your proprietary ratio is nothing but, proprietor's funds upon your total assets. So in this proprietor's funds upon total assets, what are we going to do? So in 1 rupee of total assets, how much is the proprietor's funds which is taken into consideration? So we're going to take it into consideration. Okay, so what is going to be your proprietary ratio? Your C part proprietary ratio, which will be nothing but proprietor's funds upon total assets. Your balance sheet ratio is last ratio, my dear student. This takes into consideration on 1 rupee of your total asset, how much is the proprietor's funds which has been taken into consideration. So we are going to focus on. So what's the amount of the proprietor's funds? Let's check this out. Your amount of the proprietor's funds is nothing but your shareholders' funds. So what is that amount of the shareholders' funds? 28 lakh 50 and the total asset is 52 lakh 50. And from this we'll be dividing 52 lakh 50. So what is going to be the answer? 28 lakh 50,000. Divide that by 52 lakh 50,000. So this is going to be 0.54 is to 1. Now what does it indicate? That in 1 rupee of your total funds, how much is being invested by the proprietors? So it is 0.5. So proprietary ratio is proprietor's funds upon your total assets. On 1 rupee of your total assets, what is the amount of the money which is blocked by the proprietors? Can I say automatically the balancing will be nothing but invested by the borrowed funds? Okay, so we always have to remember like this. If this ratio is actually higher, what does it represent? It represents higher stability, right? If this ratio is higher, it means that the stability is also going to be higher. Okay, and then we have something which is called as earning per share. So D part, earning per share. So how will you calculate your earning per share, your EPS? How are we going to calculate this? So for that, basically what we need is the formula, that is net profits for equity shareholders, which I'm going to divide it by number of equity shares. And what is my net profit for equity shareholders? So can I say from NPAT, if I subtract preference dividend, I'll be getting net profits for equity shareholders. So do we have the come on, yes or no? Yes, sir. What's the amount of the your amount of the NPAT here, as we have calculated, that is 7,87,500. So that's your NPAT, 7,87,500. And then, my dear students, do we have preference dividend in the question? Come on, yes or no? Yes, sir, we do have. We have the preference share capital. So as you guys can just check, we have the preference share capital, which is 6 lakhs. On that, 9%. So my dear students, from 6 lakhs, if I subtract 9%, so that is how we'll be getting 54,000. So that will be 7,33,500. So now I have 7,33,500 as net profits for equity shareholders, and I also have the number of equity shares. What are the number of equity shares which I have? 1,80,000. So now I'll be dividing this by 1,80,000. So very easily, my dear students, are we going to get the final answer, which is EPS? Yes, sir. That is 4.075. So I hope, my dear students, you will have understood the entire solution for this particular question. Okay, approach towards the question. What was the approach towards the question? How did we start? We started with what? We started with your, first of all, balance sheet, face of the balance sheet, write down the figures which are readily available. Then we understood, okay, all these things are fine. Now we have to take into consideration what is going to be your next part, which deals with your uh, all the types of other figures which we have to substitute in the balance sheet. Okay. So once we are done with that as well, and the most important crux in this particular question was the debt equity ratio, which was debt upon equity shareholders funds. So we had that ratio available with us, debt upon equity shareholders funds. So we took the entire total of the balance sheet asset side. From that, we subtracted the current liabilities. We got the total capital employed. And from that, if I subtract the preference share capital, automatically, I'll be getting equity shareholders funds and debt. So we are in the position to now apply your debt equity ratio. And then we got the total amount. So from that, what will be the debt and equity we cross multiplied, we got the answer. Okay. And once the entire balance sheet was prepared, then what's the next step? We simply have to calculate the ratios which were given to you. Okay. So that's how now we complete your question number 11. I hope you found this question interesting. Okay, just for proprietary ratio, remember that it was proprietary funds upon total assets, which indicates that in 1 rupee of total assets, how much money the proprietors are taking. Okay, so how much money the shareholders' funds are blocking. So it's nothing but proprietors' funds upon your total assets. Fine, super, great. Chalo, now we are done with your question number 11. Let us now start with the next question, which is your question number 12. Okay. Are we done first with question number 12? Yes, we are, I think, done with question number 12. Let's just check this out once. Your question number 12 is, I think, completed. So let me just figure it out. Anyone from live batch wants to tell me? Ah, yes, question number 12 is okay, got it. Okay. Now, my dear students, we'll continue further. Okay, we are done with your question number 12. Question number 13 is given. 14 is done. Okay, now we'll be first doing question number 15. Okay, let's start with question number 15. Now, see, my dear students, what is given to you? The balance sheet of XYZ company is given below, where we have on the liability side equity share capital, we have general reserve, then we have P&L for the current year, then we also have secured loan long term, we have secured loan short term, then we have creditors and we have other liabilities. On the asset side, we have your fixed assets, investment, stock, debtors, cash in hand, and miscellaneous expenditure to the extent not written off. Okay. Additional information they have told you from the profit and loss account, 90 lakhs was transferred to the general reserve during the year. And interest on the amount is nothing but 120 lakhs and the tax is 40%. You are required to calculate the debt equity ratio, current ratio, and your interest coverage ratio. Okay, fine. So if you want to calculate debt equity ratio, how will we calculate it? Simply by taking whatever is the long-term debt and we're going to divide that by equity shareholders funds. Will that give you your debt equity ratio? Come on, yes or no? Yes, sir. So let's get started now with the solution to question number 15. Let us write it down. The first ratio which we have is your debt equity ratio. And for your debt equity ratio, we have long-term debt. And we are going to divide that by your equity. So what is the amount of the long-term debt which we have? So we have the amount of the long-term debt which is 300 lakhs. And from that, we are going to subtract, we are going to divide that by equity. Equity actually stands for your equity shareholders funds, which is equity share capital plus your reserves and surplus minus miscellaneous expenditure not written off. So in this question, do we have your miscellaneous expenditure not written off? Yes or no? Yes, sir. So now what is going to be your equity share capital? Let's check this out. Your equity share capital is 250. Your general reserve is 280. Okay, so we can now write down here 250. And then your general reserve is nothing but 280. And then we also have miscellaneous expenditure not written off, which we're going to subtract it. So now this will be 250 plus 280 minus 10. So that will be 520. So now are we in the position to calculate the debt equity ratio? Yes, sir. That is 300 divided by 520. So 0.5769 is to 1. Approximately 0.58 is to 2. You can also write down this up to your 2 decimals. That's going to be 0.58. Okay, so this is your first ratio. This is your debt equity ratio. Okay. Now, which is your second ratio? Your second ratio is nothing but they have told you to calculate your current ratio. So let's calculate your current ratio. And now your current ratio is going to be current assets upon your current liabilities. So do you have your current assets available? Yes, sir. We have the current assets. We have the current asset that says stock, debtors, and cash. So we have this as stock plus debtors plus cash. And do you have the current liability available, which is nothing but creditors and other liabilities? Okay, creditors and other liabilities. But now, my dear students, we can take it into consideration what is going to be your liabilities as well. Okay, I'll tell you once again. So this short term, here in this particular case, your investments now you have a choice whether you can treat it as long term in nature as well as you can treat it as short term in nature as well. Okay, and here whether we should take into consideration your short term secured loans or not, okay, as a part of your current liability. Now this is something which I want you all to understand. See, anything which can be repaid within a period of 1 year, can we treat that as your short term in nature? Come on, yes or no? Yes, sir. So we will treat this short term loans also as the part of the current liabilities. Okay. Because this short term loans, my dear students, we will treat it like this, that it is to be repaid within a period of 1 year. So that is why we will classify that as the part of your current liability. Okay. Then we have stock, debtors, and cash. Now, investments, whether we should treat it as your short term or long term in nature. So, basically, my dear students, whenever we have no information available, we can assume that particular investments are short term investments as well, and that can be forming part of your current assets. Okay, yes, whatever queries you have you can ask in the live chat box. So in your investments, my dear students, we can treat this as your part of your short term investments as well. Okay, so if no information is given, so that is why we can treat it here as your short term investments. Okay, as the part investments, we can assume that these investments are short term in nature. So this is something which is your assumption. So even if you do it other way as well, it's absolutely fine. But I would like to go at par with what ICAI has done. So ICAI has treated this short-term investments as the part of your current assets. Okay. So they have assumed that this investments are short-term in nature. So that's why it's part of your current assets. So here we'll be having what's the amount of the stock which we have. So we have the amount of the stock, which is nothing but 460. Then we have the amount of the debtors, which will be nothing but 460 again. Whatever doubt you have, you can always write down in the chat box. Then we have cash in hand 10. What is the short term investments which we have understood 50? And we will divide this with what? We will divide this with your creditors, which appears to be 150. Your other current liabilities is 30. And then we have the amount of the short term loans, which is nothing but 360. Okay. So we will first calculate the ratio, which will be nothing but 460 plus 460 plus 10 plus 50, which will be nothing but 980, which I'm going to divide it by 150 plus 30 plus 360, and that will be 540. So this will be now treated as 1.81 is to 1. Okay, liquid ratio is also known as beta your quick ratio. So quick ratio and liquid ratio both are same. Okay, acid test ratio is also called as your quick ratio. That is also called as a liquid ratio. Okay, so whenever you see liquid ratio beta, that is nothing but your, always remember, that is nothing but your quick ratio. Okay, so your in your current ratio and liquid ratio, I hope you all are aware about it, that it is something which can be repaid within the period of immediately converted into cash. Okay, so that will be treated as your liquid ratio. Now continuing this further, current ratio, I hope you all have understood. Here we have assumed that this investments are short term in nature, and your loans which are short term, this has to be repaid within the period of 1 year. So that's why that should also be forming part of your current liability. Okay. Okay, see, I'll remove your confusion. about this different types of ratios. See, I'll tell you. There are three main types of your liquidity ratios. Okay. So there is something which is called as current ratio, quick ratio, and super quick ratio. Okay. Now see, whenever beta I talk about your current ratio, now this is called as your short-term solvency ratio. What does this ratio tells you? This ratio tells you that what is your current assets and current liabilities, what's your short-term solvency position. It means that within the period of 1 year, we are going to redeem your current assets and current liabilities. So this will actually help you to understand that what is your short-term liquidity position. And the standard ratio for this is 2:1. So for every rupee of current liability, you are required to keep 2 rupees of your current assets. Okay. That is actually the basic objective of current ratio. If you want to know whether a company is short-term solvent or not, the first thing you have to do is you have to calculate the current ratio. Okay. Quick ratio. Quick ratio is actually a ratio which helps you to understand how do we find out the immediate solvency position. Immediate solvency position. So for that, we take into consideration whatever is your quick assets and quick liabilities. So current ratio is short-term solvency position. That is 1 year. Within the period of 1 year, what is going to be the position of this particular company? Quick ratio is going to tell you that what is the immediate solvency position. So for that, that's why it's also called as the liquid ratio. For that, we take into consideration whatever is your quick assets and we divide that by current liability. Where we consider that all the types of assets are quick in nature except for two, in which we are going to subtract your stock as well as your prepaid expenses. So immediate solvency position means there should not be any loss of time or value. So there should not be any loss of time or value. There should not be any loss of any time or value. So that is what something which we represent that by quick ratio. So that's why stock, if you want to liquidate, it is going to take some time. Okay. All the current assets are quick in nature except for your stock and prepaid expenses. Because if you want that to be converted into cash, there will be loss of time or value. So that's why we don't consider. So that's why in your quick assets, we take into consideration from current assets, stock and prepaid expenses. And from this, we have to subtract your current liabilities. So this is how we are going to calculate your quick ratio. And what is going to be your standard ratio for the same? The standard ratio for this is going to be 1:1. And then we have something which is called as your super quick ratio. Super quick ratio helps you to understand that what is the liquidity which you have immediately available with you to repay 1 rupee of your current. Okay. So what is the amount right now available? No need for any conversion. So that is why for super quick ratio, we have something which is called as cash, bank and marketable securities, and we will divide this by current liability. So we will come to know on 1 rupee of current liability, how much is the liquidity right now available. So this is the entire distinguish between current ratio, quick ratio and super quick ratio. Quick ratio, we have to see what is the solvency position for the period of 1 year. Quick current ratio, we have to see what is going to be the solvency ratio for the period of 1 year. For quick ratio, we need to check what is going to be our immediate solvency position. And for super quick ratio, there is no need for any conversion. We just have to check what is the amount of liquidity which we have to repay your 1 rupee of your current liability. Okay, so that is how we distinguish your current ratio, quick ratio and super quick ratio. So is there any standard ratio for super quick ratio? Of course not. Because it depends upon companies to companies how much is the liquidity position they need to keep. Okay. I hope your confusion between quick, liquid and current ratio is absolutely clear. Okay. Also at the same time, current ratio, mein. Okay. I understood your doubts. Okay. Now let's continue this further. Your second current ratio is now done. Let us now start with the third ratio. The third ratio which we have as what we have to calculate, beta? We have to calculate the next thing which is interest coverage ratio. Okay. Now, how will you start with your interest coverage ratio? So for your interest coverage ratio, you all have to understand that we take into consideration your EBIT and we divide that by the amount of the interest. We'll be getting your interest coverage ratio because we need to check that how much number of times your interest are getting covered, okay, from the amount of your EBIT. So now we will take into consideration interest coverage ratio, which will be EBIT upon interest. Will that give you your interest coverage ratio? Come on, yes or no? Yes. From the EBIT, now I need to subtract. I need to divide that by the amount of your interest. So that will give you interest coverage ratio. And this ratio should always and always be higher the better. Because we always want your interest to be covered as much number of times as possible. Okay. So now let us see. Let us see. What do we have pertaining to your interest coverage ratio? Guys, do you have in this particular question your profit and loss account? Yes, sir. Okay, and interest cost amounts to rupees 120 lakhs. So we already know that we have your interest, which is nothing but 120. Okay. And my dear students, now let us talk about your EBIT. Okay, abhi pad lete beta. Let us now study first. Okay, then we'll discuss about the other things. So first, let us continue with your amount of EBIT. Okay. So any which way, now your amount of EBIT, we can calculate it with the help of the income statement. We have your profit and loss account, which was 90 lakhs, which was transferred to the reserves. Okay. And obviously, if we want to calculate your amount of EBIT, how will we do this? We will prepare the income statement like this. We'll be starting with EBIT. From this, I'll be subtracting interest. I'll be getting EBT, from which I'll be subtracting tax. And what is the tax rate which is given to you? The tax rate which is given to you, that is nothing but 40%. Then I'll be getting amount of your net profits after tax. Okay. Now, do I have the amount of your NPAT? Do I have the amount of the NPAT available? See, tax rate is given to you as 40%. So we have this 100. This is 40. This will be treated as a 60. Okay. My dear students, do you have the amount of the interest available? Yes, sir. Your amount of the interest is 120. So now I need to calculate what should be the amount of your EBIT, because for the purpose of coverage ratio, now we need the amount of EBIT. How will we do this? As you all can just check, we have the amount of general reserve, which is 280, and we have the amount of P&L account current year, which is 30. So can I put it like this? From whatever profits which we are earning, we are transferring some part to general reserve and some part to your P&L account. So what is the profits which has been transferred to the P&L account? So 30 is being transferred to P&L account. Now listen to me very, very, very carefully, because this is something which is going to be extremely important. Now I have from the amount of the NPAT, now I will be transferring some part to general reserve. Okay. And I have transferred some part to my P&L account. Okay. I have transferred some part to my general reserve, transferred some part to my P&L. There is no preference share capital. If there would have been preference share capital, what would I have done? From NPAT, I would have subtracted preference dividend. I would have got net profits for equity shareholders. And those net profits for equity shareholders, we need to check whether we are giving equity dividend or not. If we are not giving any equity dividend, what will we do? Entire profits we are going to transfer to the balance sheet. So here also, my dear students, are we going to transfer it to the balance sheet? Come on, yes or no? Yes, sir. How much amount are we transferring it to the balance sheet? So you guys can just check. We are transferring to the balance sheet. Can I say 90 we are transferring it to your 90 we are transferring it to your general reserve, and we are transferring 30 to your P&L account. Okay. So at least can I say 120 is being transferred? Okay. So actually things would have happened like this. From NPAT, I would have transferred something to general reserve. I would have got profits transferred to P&L. Okay. How much is my profits transferred to P&L? 30. So 30 is being transferred. What is the amount of general reserve? 90. So can I say my NPAT will now become 120? Come on, yes or no? Then the answer is absolutely yes. So we have the amount of the NPAT available as 120. And once we have the amount of NPAT available 120, now we can calculate your EBT, which will help us to calculate your EBIT. So guys, this is extremely important. From NPAT, what we are going to do, we usually subtract preference dividend. But in this question, we don't have the amount of the preference share capital. If we don't have the amount of the preference share capital, we are not going to subtract the preference dividend. So all the profits belongs to whom? It belongs to your equity shareholders. And from those which belongs to the equity shareholders, we might transfer some equity dividend. But there is no equity dividend at all. So that is why all the profits gets transferred to the balance sheet. Come on, yes or no? Yes, sir. And how are we transferring it? So first we are transferring it to general reserve, and then balance we are transferring it to P&L account. So always remember, my dear students, we first transfer the amount to reserves. Finally, all the last final profits belongs to your P&L account. So did we have the amount which is transferred to the P&L account? Yes, that is 30. How did we come to know? We came to know from the balance sheet. We have your P&L account current year, which is 30. So we have that 30 available. And then how much are we transferring it to general reserve? We are transferring it 90 to general reserve. So my NPAT would have been 20. And once, my dear students, I have the NPAT of 120. So this is going to be how much? We just have to simply cross multiply. So by cross multiplying, we'll be taking 120 into 100 and divide that by 60. So this will be 200. So your EBT is 200. And from that 40% your tax, so this is your 80. And if we go reverse now like this, can I say your EBIT amount is now going to be 320. So this will be 320. And from 320, if I now subtract, my dear students, we now divide this by interest, we'll be getting finally 2.67. So is your 2.67 to be treated as your finally your interest coverage ratio? Come on, yes or no? Then the answer is absolutely yes. Interest coverage ratio, that is nothing but 2.67. So this we usually write it down in times. So 2.67 times, which represents that your interest is getting covered 2.67 times from the amount of EBIT. Should this ratio be higher the better or lower the better? Then the answer is it should always be higher the better. Because we always want the interest to be covered more number of times from your EBIT. So that's why this ratio should always be higher the better. Have you all understood this? Okay. So this question had plenty of things for you to understand. So for debt equity ratio, as we have discussed, we should only take long-term debt into nature. For your current ratio, I told you that if no information is given to you, your investments, you can assume that as your current assets, your current investments. And my dear students, when we are talking about your current liabilities, in this current liabilities, we also have short-term loans, which is nothing but your current liabilities as well. So eventually we'll be getting this as 1.81:1. And then, my dear students, we have the interest coverage ratio, and the interest coverage ratio turns out to be EBIT upon interest. So that is EBIT upon your interest, 320 upon 120. This will together give you finally 2.67:1. Okay. I hope, my dear students, you all have enjoyed, you all have understood this particular question. Okay. So how did we get the amount of your NPAT? From that we subtracted general reserve, we got the profits transferred to the P&L account, we went reverse and we did the necessary calculations. Okay, great. Chalo. Now with this we can say that your question number 15 is now completed. Okay. Now I want you to please come to your question number 16. Okay, so let's start with this particular question number 16. Following figures are available in the books of Tirupati Limited, where, my dear students, we have fixed assets turnover ratio, which turns out to be 8 times, and that is based on your COGS. Then we have the capital turnover ratio. Capital turnover ratio is given to you as 2 times. This is nothing but capital employed turnover ratio. Okay. That is also based on COGS. Guys, things are different here. Usually your fixed assets turnover ratio is always calculated by taking your sales upon your whatever is your fixed assets. In this particular question, we are going to take into consideration COGS upon fixed assets. Capital employed turnover ratio, we take into consideration same COGS upon your capital employed. Usually we take into consideration sales, but specific information prevails over your general. So we have to take into consideration your COGS. Then we have something which is called as your inventory turnover ratio, that is a stock turnover ratio. And guys, your stock turnover ratio anyway has to be calculated by taking COGS upon your average stock. After which we have receivables turnover ratio. Receivables turnover ratio, also known as your debtors turnover ratio, where we take credit sales and we check whatever is the average debtors. Then we have payables turnover ratio. Here we take into consideration the credit purchases, and then we have the GP ratio available. Gross profit during the year amounts to rupees 8 lakhs, and we also have there is no long-term loans or overdraft which is available to us. Reserves and surplus amount to rupees 2 lakhs, and ending inventory of the year is 20,000 above the beginning inventory. Calculate the various assets and liabilities, and we are now required to prepare the balance sheet of Tirupati. Whenever you see that we are required to prepare the balance sheet, the first thing which should come to your mind is what? Sir, we have to now start with the face of the balance sheet. Okay, that's the first thing which is important. We have to now start with what? Better, we have to now start with the face of the balance sheet. Okay, so let's get started. Now, solution to question number 16. Let's write it down. Question number 16. Messrs. Tirupati Limited balance sheet as on what do we have here? Balance sheet as on. We don't have here the date available. It's okay. You can simply prepare this in the T format. Here we have liabilities, here we have rupees, here we have assets, we have rupees. What do we have next? What are the list of liabilities and assets which we can write down in the face of the balance sheet? So here we have something which is called as your equity share capital. So we'll be taking into consideration your equity share capital. Then what do we have next? We have something which is called as your reserves, but here I cannot see any reserves. Acha, they have given to you here. There is no long-term loan, but reserves and surplus amounts to rupees 2 lakhs. Okay. So we have reserves and surplus amounting to rupees 2 lakhs. The total of this actually gives you your equity shareholder funds, also known as net worth. But definitely there is no preference share capital in this particular question. There is no long-term loan. Okay, so there's no debt in the capital structure. So that's why we'll be simply writing down your current liabilities. Okay. Now, in your current liabilities, they have told you that you actually have your in your current liabilities. They have told you that you have payables. Payables means, can I say there is going to be creditors? Come on, yes or no? Yes, sir. So there is creditors in this particular ratio. Payables means your creditors. Okay. And then what do we have next? We have on the balance sheet asset side. Some of the assets, what are the types of the assets which can be available? So definitely there is going to be fixed assets. And then, my dear students, we usually have investments, but there is no investments here. But definitely there is going to be current assets. And in your current assets, will there be any stock? Yes, sir. Will there be any debtors? Yes, sir, because there is both these ratios available. So balancing part can be your other current assets. Okay. So this is what the question is all about. This is what the face of your balance sheet looks like. Now we just have to calculate with the help of this particular ratios which are given to you. We just have to simply calculate this and substitute the values. Okay. So how are we going to now do this? So we have here gross profit which is given to us 25%, and we have the gross profit amount also available. Wow, how easy. Can I say now we are in the position to calculate first the sales? Okay. So let's do that. Working note number one. Working note number one. And this is now going to be your calculation of sales. So what do we have here? GP ratio, and that is going to be gross profit upon sales required. So what is the GP ratio which we have? We have the GP ratio which is 25%. So this is 25 is equal to what's the amount of the GP? The amount of the GP is 8 lakhs. What is the amount of the sales? Let this be X. So this will be 30 lakhs. So now do I have the amount of the sales available? Come on, yes or no? Yes, sir. We have the amount of the sales which is 32 lakhs. What's the second ratio? The second ratio is that from your sales, now you have to subtract the GP to get the COGS. So sales minus GP will give you COGS. So what's the amount of the sales which we have? 32 lakhs. What's the amount of the gross profit which we have? 8 lakhs. So this will now be 32 lakhs minus 8 lakhs. So that will be 24 lakhs. Now, is this COGS going to be extremely helpful for you to come on? Yes or no? Yes, sir. Because we are now required to calculate the other ratios. And to calculate the other ratios, the COGS is going to play a very important. Okay, because now you can see in the third part, we have something which is called as your uh, first. Let us start with fixed assets turnover ratio. Fixed assets turnover ratio. It's going to be COGS upon your fixed assets. Now, what is the proportion? What is the fixed assets? What is the COGS? So here, first of all, the turnover ratio is nothing but 8 times. So this will be 8. COGS is 24 lakhs. So let the fixed assets be X. And based on this, can we calculate the amount of the fixed assets? Yes, sir, that will be 3 lakhs. So now do I have the fixed assets available? Yes, sir, that is 3 lakhs. Right. Now after this, my dear students, what next do we have? We have capital turnover ratio. So capital turnover ratio. So now what is going to be your capital turnover ratio? So usually it is to be treated as your capital employed. Okay. Now in this particular case, so this particular case, your capital employed will now be calculated by taking this into consideration, which will now be 2 times NI. So this will be your 2 is equal to what's your amount of COGS? The amount of COGS which you now have calculated, that is 24 lakhs. So let this be X. So this will now be 12 lakhs. Okay. Now, is your 12 lakh your capital employed? Come on, yes or no? Yes, sir. So this includes your equity share capital as well as your reserves and surplus. But do I have the amount of the equity share capital? No. But do I have reserves and surplus? Yes. How much is my reserve surplus? 2 lakhs. So this will now give me 10 lakhs. So now do I have my equity share capital amounting to rupees 10 lakhs? Come on, yes or no? Yes, sir. So I can substitute here 10 lakhs. The total of this will be 12 lakhs. Okay. Stock turnover ratio. Can I use stock turnover ratio right now? Then the answer is yes, we can use your stock turnover ratio. So your fifth part will be your stock turnover ratio. And your stock turnover ratio is actually your COGS upon your average stock. Because it goes without saying that stock should be valued at cost. So we have the COGS available with us. So for that, we'll be taking COGS upon average stock. And what is the stock turnover ratio which they have given? That is 8 times. So this is 8 times. So 8. So 8 is equal to. Can I say sales minus GP will give you COGS? Yes, sir. So what is the amount of your COGS? Your COGS is 24 lakhs, right? So we'll be now taking 24 lakhs and dividing that by the average stock X. Okay. So in this particular case, what's your average stock? It's going to be 3 lakhs. This is your average stock. Do I actually now have details of opening and closing stock? Yes. Ending inventory of the year is 20,000 above the beginning inventory. So let the opening inventory be X, right? So what we have got is this is your average stock. So your average stock is 3 lakhs. But we don't substitute your average stock in the balance sheet. What we substitute is the closing stock. So to calculate the closing stock, now what are we going to do? So let the opening inventory be X. Okay, so what is average stock? 3 lakhs. So opening plus closing divide by 2 is nothing but 3 lakhs. So let the opening be X. So your closing, they have told you here that your closing is nothing but 20,000 above the beginning inventory. So it's 20,000 above the beginning inventory. So if this opening stock is going to be your X, can I say your closing stock is now going to be X plus the amount which it has increased? And what is that amount? That's nothing but 20,000. So that will be X plus 20,000. Divide that by 2. And this is nothing but 3x. So now are we in the position to calculate your opening stock first? Come on, yes or no? Yes, sir. So this will now become 2x plus 20 upon 2 is equal to 3x. So this will now be 2x plus 20 is equal to 6 lakhs. What's your x? 5 lakh 80. Divide that by 2. So 2 lakh 90. So now I have my opening stock as 2 lakh 90. This is not yet the final answer. Why? Because your closing stock is 20,000 more than the opening stock. So to this now I'm going to add 20,000. So what will I eventually get closing stock? And how much is that amount? 3,10,000. So is this closing stock of 3,10,000 going to come here? Come on, yes or no? Yes, sir. It will come here. Stock 3,10,000. Stock is going to be your 3,10,000. Have you all understood the approach? How are we going to solve this particular part? So here, what did we do? We took the COGS and first we calculated the average stock. See, usually if opening stock is not given to you, then we always take that closing stock itself is your average stock. But here in this question, they have specified that closing stock is 20,000 more than the opening stock. Now, in that particular situation, can I say we have to calculate this particular stock? Come on, yes or no? Yes, sir. And we got the amount of the opening stock as 2,90,000, but your closing stock is 20,000 more than that. So that is why this will now be treated as your 3,10,000. And is this 3,10,000 going to come on our balance sheet asset side? Come on, yes or no? Yes, sir. 3,10,000. Continuing further. Receivables turnover ratio. Can I say receivables turnover ratio is also known as a debtors turnover ratio? Yes, sir. So how are you going to calculate your debtors turnover ratio? 6 months. Credit sales upon average debtors. But guys, do you have any opening available? Then the answer is no, there's no opening available. So that's why whatever debtors are going to come, can I say that itself is going to be your closing debtors only? Come on, yes or no? Yes, sir. So that is why this is nothing but 4 times. So this is 4 is equal to what's your credit sales? Your credit sales, let that be treated as your, that is available to you. And that is nothing but how much? 32 lakhs. Right? We have this as 32 lakhs. So let this be 32 lakhs. So now are we in the position to calculate the amount of the debtors? Yes, sir, we can calculate it. So that is going to be 8 lakhs. So this 8 lakhs, can I substitute it here? Yes, sir, you can. 8 lakhs, that's your debtors. Okay, so your debtors is also done. Okay, what about your payables turnover ratio? Can I say this will actually help you to calculate your amount of the creditors? So payables turnover ratio, working note number 7. Creditors turnover ratio. Now, what does this indicate? That how much number of times in a year I'm going and making the payment to the creditors. And this ratio should always and always be lower the better. Why? Because you always want to go and make the payment to the creditor for lesser period of time in a year. So that is why usually your creditors turnover ratio should be lower the better. And this creditors turnover ratio, will it actually help you to calculate your finally creditors payment period? Come on, yes or no? Yes, sir. So from 1250 to 365, if I divide that by creditors turnover ratio, I come to know what's going to be my creditors payment period. So your creditors turnover ratio will be nothing but your credit purchases, and that we will be dividing it by average creditors. Credit purchases upon your average creditors. Now you must be wondering, sir, how will we calculate purchases? It's okay, we can calculate purchases. How? Because my dear students, we actually have your COGS. So what is COGS? Opening plus purchase minus closing. Now, do I have the amount of the COGS available? Come on, yes or no? Yes, sir. I have the amount of COGS. And how much is the amount of the COGS which is available? That is 24 lakhs. So if we have this as 24 lakhs, what is the opening stock figure? That was 2 lakh 90. Let the purchases be X and closing stock is 3 lakh 10. Acha, if this data would not have been given to you, then your COGS itself would have been purchases. If no data is available. But my dear students, if we have the COGS opening, closing, everything available, are we in position to calculate the amount of the purchases? Come on, yes or no? Yes, sir. So let's do this now. This will be 2 lakh 40 is equal to minus 20 plus X. So this will now be 2 lakh 16 is equal to X. Do I have the amount of the purchases also available? Come on, yes or no? Yes, sir. Now I have the amount of the purchasable. What will I do with the amount of the purchase? Can I go and substitute it there? Yes. How much is that? 2 lakh 60. So now my credit purchase is 2 lakh 60. Creditors. And how much is the status turnover ratio? That turns out to be 6 times. So what will be the amount of my creditors? 43,333. So now we should be getting this amount of the creditors, which should be coming around. Creditors is coming around. Your credit purchases, 1 second. Oh, this is not 2 lakh 40, sorry, this is 24 lakhs. I've written this as 2 lakh 40. This is actually a 24 lakhs. Okay. So this will be 24 lakhs. So this will now be 24 lakh 20,000. Okay. So we'll be now having your creditors as 24 lakh 20. So what's going to be your creditors? 24 lakh 20, which I need to divide it by 6. This will be 4 lakh 3,330. This will be the amount of my creditors. 4 lakh 3,333. And where am I going to substitute this 4 lakh 3,333? So I can go and now substitute that in my 4 lakh 3,333. Okay, so that is actually going to be your amount of your creditors. So now, my dear students, we are in the position to now complete the entire balance sheet. So we have this as 16 lakh 3,333. This is also 16 lakh 3,333. So we'll be left with your this current assets total, which will now appear as 13 lakh 3,333, and this will now be balancing part, which will now be 13 lakh 3,333 minus 3 lakh 10 minus 8 lakhs. So that should be 1 lakh 93,330. This is how the solution will be done. Okay. So creditors turnover ratio helped us to calculate the amount of the creditors. Okay. And for that, credit purchases was very important. So how did we calculate the credit purchases? We took into consideration COGS, which was opening stock plus purchases less closing stock. So we took into consideration what is going to be your COGS, what is your opening stock, what is your closing stock. Let the purchases be X. We calculated, we got the purchases. And that purchases helped us to calculate the amount of the creditors, or what the creditors. Always remember like this. Your creditors turnover ratio should take into consideration your credit purchases upon your average creditors. Only if suppose your opening creditors are not available, we'll take into consideration closing creditors, as the case was here. We got the purchases, we got the creditors, and that creditors we substituted here. And eventually we got the total of your assets. In that we got current assets, and then the balancing part will be treated as your other current assets. Okay. I hope, my dear students, you all have understood this particular question as well. So now with this, your question number 16 is also done. Okay. So 16 done, 15 also done. 14 we had completed the last lecture. 16, 15, 14. 13 we are yet to do. 12 done, 11 done, 10 also we are done. 9 we are done with question number 9 as well. Okay, then 8th also done. We are done with your 7th. Yes, 6th we are yet to do. Okay, 6th. So first we will do question number 6 and then we will do question number 13. Okay, so let's get started. Let's start with your question number 6 first. From the following ratios and the information given below, we are required to prepare the trading P&L account and the balance sheet of ABC company. Okay, so we are required to prepare the trading P&L account and the balance sheet. So we have here fixed assets, we have closing stock, we have stock turnover ratio, we have GP ratio, net profit ratio, net profit to capital, capital to total liabilities, fixed assets to capital, and fixed assets to total current assets. So we are required to prepare trading profit and loss account and the balance sheet. So always remember what is a standard process. What is our first step? Are we going to prepare the format of trading P&L account and the balance sheet? Come on, yes or no? Yes, sir. And substitute the items which are already available. They are, whatever is known to you, we are going to substitute with that. So let's get started now. Solution to question number 6. What is the name of the question? We have here Messrs. ABC Company. ABC. Okay, balance sheet as on. And here, my dear students, we are going to have, first we'll write down trading P&L account. Sorry. We'll write down like this, trading and P&L account for the year ended. We don't know what is it. Okay. And we'll prepare this for approximately 15 lines. And then we are also required to prepare balance sheet. Liabilities rupees, assets rupees. Which all items are going to appear on the face? Now let's first do that. First we'll be having fixed assets. So we'll write down your fixed assets. And then we'll be having, do we have any long-term investments? No, but yes, current assets will be there. And my dear students, in your current assets, what are the list of the items which can be available? So now, my dear students, we don't have any further list of the current assets. It means, see, which all things are going to be there. Stock is going to be there. And there is no debt collection period, etc. So we don't know. So we'll be just simply taking stock and other current assets. Okay. Then on the liability side, which all things are going to come? So we'll be having equity share capital. Yes, sir. Reserve and surplus not given to you. But yes, this will be your equity shareholders funds, also known as a net worth. And then what do we have next? So we have your, do we have any long-term loans available in this particular question? Do we have any long-term debt available in this question? Then the answer is no. But here, my dear students, from this, if I subtract my current liabilities, okay, what do we have it in the current liabilities? Do we have any of your creditors, etc., which is given to you? No. So we just have only one. There is no overdraft, etc., which they have told us. So there is only current liabilities. Okay. So now let's get started. The figures which are readily available. Achha, this is the balance sheet. But what about your trading P&L account? So we'll be having your two opening stock. My closing stock. And then, my dear students, we have buy sales. Here we'll be having to gross profit carried down. Why gross profit brought down? Okay, this should be by gross profit brought down. Gross profit brought down. Now, what do we have next? So we'll be having here two net profits carried down. And here, my dear students, we have no interest, etc., available. So this will be treated as your two indirect expenses. Indirect expenses. Okay. So this is going to be your face of your trading P&L, and this is going to be face of your balance sheet. I hope you all have understood this much. The first step is to prepare the face. We are done with the face, and now let us substitute the values which we already have. Do you have fixed assets? Yes, sir. We have the fixed assets which is 40 lakhs. So we can substitute here with the fixed assets which is 40 lakhs. That is given to you. And then, my dear students, what do we have next? We have closing stock which is 4 lakhs. Okay, fine. So we have closing stock which is 4 lakhs. So stock is 4 lakhs. This is also given. And where will be the second effect of this 4 lakhs? So that will actually go to your trading account. Here we are going to write down 4 lakhs. Okay. Then, my dear students, do we have your stock turnover ratio? Do we have stock turnover ratio? Stock turnover ratio, that is nothing but 10 times. So now for stock turnover ratio, what are we going to do? We will be taking into consideration your stock turnover ratio. Working note number 1, stock turnover ratio. Now what's your stock turnover ratio? That's nothing but your COGS upon average stock. So we have the stock turnover ratio which turns out to be 10 times. So this is 10. Do we have your COGS available? Do we have the COGS available? COGS. Let that be X. And for average, there is no opening data which is given to you. So we'll be taking this as your opening plus closing divided by 2. But this itself is your average stock is nothing but your closing stock. So that will be 4 lakhs. So this will be your 4 lakhs. So what is now going to be your COGS? That's going to be 40 lakhs. So will your COGS be 40 lakhs? Yes, sir. Then continuing this further, what next do we have? We have your next as your gross profit ratio, which is 25%. So working note number 2, gross profit ratio, and that is nothing but gross profit upon sales into 100. Okay. So we have the GP ratio, which is 25%, but that 25% is always of the sales. Okay. So can I put it like this? COGS plus GP, that will give you your sales, and your gross profit ratio is nothing but 25%. So this is 25% on sales of 100. So the COGS is actually 75. So then if the COGS figure is 40 lakhs, are we in the position to calculate the amount of the sales? Yes, we can. So that is 40 lakhs into 100, divide that by 75. So that will be nothing but 53 lakh 33,330. So that's the answer which we are getting for your this particular part. Okay, 53 lakhs something. Okay. we are doing this question number 6 only, na? Right? Okay. So here, what do we have? What's the amount of the sales which we are getting? Okay. 1 second. Okay, in this particular question now, oh, fine. We have the amount of the fixed assets available. So, you know what we will do is first, before we continue this further now, what we will do is we have the amount of the fixed assets available. So, we would rather start with the ratio in which the fixed assets amount is available. What's the amount of the fixed assets which is given to you? That is 40 lakhs. Okay, so see now, how will I solve this? See, your first working note I will actually take is your fixed assets to capital. See, you all can just check this out here. We have this as fixed assets to capital. So let's start with this ratio first. Fixed assets to capital. And this ratio is nothing but how much is to 5 is to 4. Okay, so we have this as 5 is to 4. So what's the amount of the fixed assets which you have? Always start with the question in which the figures are readily available. So we have the figures of fixed assets available, which is 40 lakhs. So I'll start with 40 lakhs. Okay. And what's the amount of the capital? So the amount of the capital which we don't know, let that be X. Okay. This is 5 upon 4. So what will be now your amount of your capital? So that is now going to be 40 lakhs, divide by 5, multiply that by 4. So that is going to come as 32 lakhs. So now my dear students, I have the amount of the capital which is 32 lakhs. Okay. So capital is 32 lakhs. So I can write down here your capital because right now there is no reserves and surplus which is given to you. So this itself will now become 32 lakhs. Okay. Then continuing further, we have fixed assets to total current assets, that is 5 is to 7. So we can do this as well. Fixed assets to your total current assets. So what are the fixed assets to total current assets? That is 5 is to 7. So do I have the amount of the fixed assets? Come on, yes or no? Yes, sir, we have the amount of the fixed assets, that is 40 lakhs. So try and start with the ratios for which the figures are readily available. So fixed assets was available. So instead of doing stock turnover, etc., if fixed assets is available, let us start first with the fixed assets ratios. So now this will give me my total current assets, which will be 40 lakhs. Divide that by 5, multiply that by 7. So that will be 56 lakhs. So now I have my total current assets, which is 56 lakhs. So we have total current assets, which is 56 lakhs. Okay. We have got this as 56 lakhs. Fixed assets upon total current assets is 5 is to 7. Sorry. Fixed assets to total current assets is 5 is to 7. So 7. So your total assets should be coming as your 56 lakh rupees. Okay. And now what we will do is we will substitute that here. 56 lakh rupees will be coming here. Okay. And this total will now be 56 lakh plus 40 lakhs. So that's going to be 96 lakhs. So this 96 lakhs will also come here. 96 lakhs. Okay. And this is 56 lakhs. So now are we in the position to calculate the other current assets? Yes, but wait. This is 96 lakhs which is given to you. Let us see what other things can be possibly calculated from this. Capital to your total liabilities. Okay. We have capital to total liabilities. So let's do that. To total liabilities because we have the total liabilities available, which is nothing but 96 lakhs. So your third working note, capital to total liabilities. So what is the total liabilities which I've just now got? I've got the total liabilities of 96 lakhs and this capital to total liabilities appears to be how much? 1 is to 2. So this is 1 upon 2. So now in this particular case, what is the amount of the capital? So amount of the capital is 32 lakhs. So this will now be 32 lakhs. Okay. So here your total liabilities is coming as 64 lakhs. So let this be 32 lakhs upon X is equal to 1 upon 2. So that is why this will now be total of liabilities will now be 64 lakhs. Okay. Now see always remember like this, that there is a difference between total of liability side and there's a difference between total of liabilities. Here, my dear students, we have the total of liability side as rupees 96 lakhs. But the total of liabilities can be what? It can be external liabilities. It can be current liabilities and long-term loans. Put together, that can give you a total liabilities. So here in this particular case, your total of liabilities is coming as 96 lakhs, but your total liabilities, how much is it coming? Your total liabilities is coming as what? It is coming as your 64 lakhs. Now, what does it represent? It represents that in your 64 lakhs, there can be some current liabilities as well. Okay. But for that, we don't have right now the data available. We will see how should we solve with this. But can I put it like this? Some long-term loans and current liabilities put together right now is coming as how much? It is coming as your 64 lakh rupees. So we have this total as 64 lakh rupees. Okay. So 32 lakh plus 64 lakhs, that will give you 96 lakhs. So basically we have the total of your liability side which appears to be 96 lakhs. So 32 lakhs is your equity shareholders funds. Your total of liability side is 96 lakhs. Okay. So your total liabilities appears to be how much? It appears to be 64 lakh rupees. Okay. Now, do we have net profit ratio available? Yes, that is 20%, and we have net profit to capital which is 1 by 5. So let's calculate now. Working note number 4. Net profit to capital. How much is that? It is nothing but 1 by 5. 1 by 5. Okay. Now, my dear students, what's the amount of my capital? My amount of the capital is available as 32 lakhs. So this will now give me my net profits. 32 lakhs is equal to 1 by 5. So therefore, my amount of the net profits is going to be 32 lakhs. Divide that by 5. So that will be 6,40,000. Now, do I have the NPAT available? Come on, yes or no? Yes, sir. I do have the NPAT. And this NPAT is nothing but 6,40,000. With the help of this NPAT, I can use this net profit ratio. So what's my net profit ratio? NPAT upon sales into 100. This net profit ratio is 20%. So this is 20. NPAT is 6,40,000. Let the sales be X. So will you be getting the amount of the sales? Yes. That is 6,40,000 divided by 20 into 100. So that appears to be 32 lakhs. Now, my dear students, we need to take this sales. So this sales is 32 lakhs. So I'll substitute your sales as 32 lakhs. Okay, I'll substitute your sales as 32 lakhs. Okay. Now, my dear students, we are done with the sales also. What's the GP ratio? 25%. Okay. So sales was 32 lakhs and my net profits was how much? My net profits was, we calculated that was nothing but 6,40,000. Okay, so we had a net profits of 6,40,000. So I can write down net profits of 6,40,000. We have written sales of 32 lakhs. Also at the same time, my dear students, what's the GP ratio? The GP ratio is nothing but 25%. So this is going to be 25% of sales. So 32 lakhs cut 25%. This will now give you 8 lakhs. So this will be 8 lakhs. Okay, so your other expenses is now going to be 8 lakh minus 6,40,000. So that is now going to be 1,60,000. So this is going to be your other expenses. Okay. Now at the same time, do we have your stock turnover ratio? Yes, sir. We have the stock turnover ratio is 10 times. Okay. And we also have the closing stock, which is available as 4 lakhs. So this will actually help you to calculate what is going to be the opening stock. Okay. So closing stock is 4 lakhs. So now we will use the stock turnover ratio. So your working note number 6. Your stock turnover ratio. What's your formula for stock turnover ratio? That is COGS upon your average stock. So your stock turnover ratio is nothing but 10 times. So this will be 10. What is the amount of the COGS? Your amount of COGS is sales minus GP. So do we have your amount of the sales? Yes, sir. We do have the amount of the sales. So your amount of the sales is nothing but 32 lakhs and your GP is 8 lakhs. So from 32 lakhs, if I subtract 8 lakhs, what do I get is 24 lakhs. So that's the amount of the GP. Okay. COGS, that is 24 lakhs. And let this be average stock X. So what's your average stock going to come? 2 lakh 40. Now what is average? Average stock is opening plus closing, divide that by 2. So I have this as 2 lakh 40. What's my opening stock? X. Let it be X. And do I have the amount of the closing stock available? Yes or no? What's the amount of the closing stock? Just check. The stock amount is given to you as 4 lakh rupees. So this is going to be 4 lakhs upon 2. So this will now be 4 lakh 80 is equal to X plus 4 lakhs. So what your X is going to be, that is 80,000. So what is this 80,000? Can I say this 80,000 is nothing but your closing stock? Come on. Yes, opening stock, yes or no? Yes, sir. Average is how much? 2 lakh 40, na? So 80 plus 40 divided by 2. 2 lakh 40 is the average coming. Okay, 80,000. So your opening stock will be treated as your 80,000, which I can write down here 80,000 as opening stock. Okay. So your opening stock should be coming as 80,000. Great, perfect. Okay. Now next, continuing this further, we have the fixed asset stock turnover, everything was done. So guys, always remember that we should always and always start with the ratios from which the direct figures are available. So we had those direct figures available. We had your closing stock, we had the fixed assets. So we started with fixed assets, we went reversed, we got the amount of the net profits, and that is the concept which we use to actually calculate the final amount. Okay. Now what is going to be your final answer here? This will be two purchases. So what will be your purchases? 32 lakhs plus 4 lakhs. So that is 36 lakhs. And from your 36 lakhs, now I will be subtracting 8 lakh 80,000. So this will now give you 2 lakh 72,000. No, 27 lakh 20,000. So this 27 lakh 20,000 will be treated as your purchases. Okay. So finally, what is going to be your other current assets? 52 lakhs. And we don't have any breakup available. So this itself will be nothing but 32 lakhs. Okay. So this is the format of your trading P&L and your balance sheet, which we need to do it. Okay. Have you all understood this? So how did we start? Fixed assets and the ratios regarding the fixed assets first. Keep on substituting those. Okay. So that is how the calculation will be entirely done. So this was the first ratio from which we had to start. In examination also, always follow this. Start with the ratio from which the figures are readily available, and then go reverse and do the other calculations accordingly. Okay. Sure. Great. Now with this, question number 6 is done. Now we are left with only the last question, which is actually your question number 13. Okay. Now this question is extremely lengthy. Okay. This question number 13 is very lengthy. So what we're going to do here is, I have already solved this question number 13. Okay. So we need to now understand and refer to the entire solution of how this question number 13 is to be solved. Okay. And what is the approach which is going to be for this question number 13. Okay. And you can just refer to this entire solution. Okay. Just refer to this entire solution right now with me. And then I'll give you time to take the photos and the screenshots for this particular solution. You can then take the photo and you can practice this on your own. Okay. So question number 13 is extremely lengthy, and it has many calculations. Okay. From the examination perspective, I'm not expecting this question to be asked. Why? Because this question, while solving only, will take lots and lots of time. But yes, part of this question can be asked in the exam with the help of case study MCQs perspective, and they can ask you the MCQs from the same. So I don't want to leave this particular question as an option. We have to solve this, but how? First, I'll be explaining you the entire solution, how it is to be done. You can take the photo of this and then you can solve it on your own. Okay. So let's get started now with your question number 13. From the following information, you are required to prepare the summarized balance sheet of Rudra for the year ended 31st March 2023. So we have your debt equity ratio, which is 1:1. We have the current ratio, which is 3:1. We have fixed assets, okay, turnover on the basis of the sales, which is 4. We have stock turnover ratio on the basis of the sales, which is 6 times. We have cash in hand, we have stock to debtor, we have sales to net worth, capital to reserves, gross profit, and COGS to creditors. Interest for the entire year is to be paid at 10%. If you just check, we have just gone through the entire question. There is only one figure in rupees which is available, and that is nothing but your cash in hand, which is 5 lakhs. That's it. We don't have any other thing which is available. So this question needs to be solved in a very tactful manner. Okay. First of all, as I told you, what we have to do, we have to prepare the entire phase, okay, of the balance sheet. So this is now your solution to question number 13. Okay. We have to prepare the entire phase. So which all phase, which all items are going to come? So there is going to be capital, reserves and surplus. The total of this is equity shareholders funds. Then there will be debt, long-term debt. Then there will be current liability in which there is there is creditors. Then there is other current liabilities. Okay. But as you guys can just check, they have told you that interest is yet to be paid. So obviously there is going to be other current liabilities, outstanding interest also come on. Yes or no? Yes, sir. So there is going to be outstanding interest as well. On the asset side, then we have fixed assets. Then we have your current assets in which there is stock, debtors and cash. Okay. So first we just have to write down the face of your entire balance sheet. How are we going to solve this particular question? So because we only have the cash figure available, so the first thing is we just have to put cash and keep it as it is. All the other things we have to solve it. Okay. Now, you guys can just check. In this question, they have told you that fixed assets turnover is based on sales. Stock turnover is based on sales. Okay. Of course, we don't have the amount of the sales, but here we have sales to net worth. So basically, what are we going to do here is, first of all, we will be assuming let the sales be X. So that's the starting point. That's the first thing which we need to start with. So we are going to start with the sales which will be X. So we have written here, let the sales be X. So your fixed asset turnover ratio will be sales upon fixed assets, let the sales be X. So we got the fixed assets to sales, which is X by 4. Okay, X by 4. And we have to keep it right now X by 4 only. So your fixed assets is going to be X by 4. See, your fixed asset turnover ratio is 4. Let the sales be X upon fixed assets. So if I take down fixed assets here, so this will be X by 4. Okay, so do we have the fixed assets available as X by 4? Yes, sir. So we can just write down your fixed assets as X by 4. Okay, in the inner column. We still don't know what's the amount. Okay. Then we have stock turnover ratio, that is also based on sales. So that's why we have taken sales upon closing stock. So that is X by 6. So we have this also as X by 6. So we can write down here stock also as X by 6 and keep it as it is. Then we have the next ratio, okay, which will be now your sales to net worth. So sales upon net worth, let the sales be X. So we got the net worth as as X upon 4. So we can just simply go here and write down X upon 4 and keep it as it is. Okay, so this is going to be X upon 4. Then my dear students, what do we have next? We have your cash in hand, which we have already written. Okay, then they have also told you stock to debtor is 1:1. So obviously, whatever is my stock, that's my debtor. So this is X by 6. Now, have you realized that your total of assets side, at least this X figures are done. See, we have X component for everything. Fixed asset is X by 4. Stock is X by 6. Debtor is X by 6. Cash is actually given. Here we have your equity shareholders to net worth, that is X by 4. We still don't have the figure available, but that is X by 4. And also we can check here, we have the debt equity ratio as 1:1. So now my dear students, once we have the debt equity ratio as 1:1, so can I say what is the proportion of the debt? That will be same proportion of equity. So if this is X by 4, this will also become your X by 4. Okay. So right now we just have to write down all the things which we need to calculate it in terms of X. Only then we can continue this further. Current ratio is 3:1. So now what is going to be my current ratio? See, as you all can check here, your current ratio is nothing but, okay, 2:1. Okay, as you all know, current ratio they have given is 3:1. So current ratio, we know there is stock, debtors and cash. And in current liability, we know creditors, other current liabilities, and outstanding liabilities, outstanding interest. So this was X by 6 because both of them were same. Your cash was 5 lakhs. So your current liabilities appear to be how much? Your current liability, then if you solve this, your current liabilities, okay, is coming as X by 9 plus 5 lakh plus 3. So this is the total of the current liability. Okay. Now, my dear students, what is going to be my current assets then? So if current ratio is 3 is to 1, so current assets, my current liability is 3 upon 1. So current assets, we can find it out, which will be nothing but X by 3 plus 5 lakh rupees. So this will be the total of the current assets. So now my current assets is X by 3 plus 5 lakhs. So the total of this is nothing but, X by 3 plus 5 lakhs. And what's the total of the current liabilities then? The total of the current liabilities is nothing but X by 9 plus 5 lakh upon 3. X by 9 plus 5 lakh upon 3. So this is nothing but X by 9 plus 5 lakh upon 3. So this is the total of my current liability side. Now, my dear students, here we now have for each and every item, we have its X component available. So we have this as X by 4, we have this as X by 4. The total of current liability, we have this as X by 9 plus 5 lakh by 3. We have the total of current assets as X by 3 plus 5 lakhs. And we have the total, we have the fixed assets as X by 4. Okay, so this much we have it. Okay. Now, my dear students, they have given to you that GP ratio is 20% on cost. So if GP ratio is 20% on cost, so can I put it like this, that GP ratio is 16.67% on sales? Okay, so it's simple. If it's on cost, then we can also calculate this on sales. So if it is on cost, so let cost be 100. So GP is 20. The selling price is 120. So based on this, we know that, okay, your GP can be 20% on cost. So 16.67% on sales. Because as you all can just check, if this is 83.33, okay, because now we want to calculate this as a percentage on sales. So that is why this will be 16.67% on sales. Now, once we have this GP as 16.6% percentage on sales, that is nothing but 1/6 of sales. So this is 1 by 6x. And your COGS will now become 5 by 6x, because if it is 1/6 of sales, your COGS will now become 5 by 6, because that's how the total sales is going to come. And now, how do you calculate your creditors? So COGS, because have they given you any ratio for the same? COGS to creditor is 10 is to 1. So COGS to creditor is 10 is to 1. So 5 by 6x upon creditor is 10 upon 1. And based on this, I have got this as 1 by 12x as your creditors. So we have now this creditors also available with us, okay, which we just now calculated with the help of that particular ratio. What we need to do next now, we have to now use your basic accounting equation. What was your basic accounting equation? Normally, we know that it is shareholder fund is equal to application of funds. Or else we can also write down this as total of assets is total of liability side. So fixed assets plus current assets, that is net worth plus long-term loan plus current liability. So whatever figures in X which we got, we just substituted that. And ultimately, once we take all the X on one side and solve it, we'll be getting this X as 1 crore 20 lakhs. So 1 crore 20 lakhs which we got, that was nothing but the amount of your X. And we had assumed your sales to be 1 crore 20 lakhs. So once we have the sales available as 1 crore 20 lakhs, what next we need to do? We just have to now substitute this X in all the figures and get the other answers. So we'll be getting the current liabilities as 15 lakhs, and then all the other items, once we substitute the value of the X, this entire balance sheet will be completed. And then the balance sheet is getting tallied at rupees 75 lakhs. So guys, this question needs one-time practice from your end. I've just explained you what's the approach to the question. I will be definitely, this particular solutions, it will be there in your YouTube description as well, the details of it. So y'all can just, complete this, try this on your own. Okay, because see, this question is extremely lengthy. Again, I'm repeating, I don't know whether this will be asked in the examination or not. Very doubtful. But still we have to just go through it once. Okay, just practice it once. Okay, this entire question for you to solve will take exactly 1 hour. Okay, and uh, you can now start taking the photos or the screenshots of the same. So this is your question number 13. If you want, you can just simply take the photocopy, the photo of this particular question. So this is your first part. Then this is your second page in which we started with your sales. Okay. Then I'll just present you the entire solution. This is your next page. Okay. Then this is the page after that. So you just see the volume, the working notes which we have to do it. It's extremely large. Then we have this. Okay. And this one. So this is how, my dear students, we complete your entire question number 13. And you just have to go through that once. Do it by the way of your, normal calculation, assume X and solve it accordingly. And with this, my dear students, your entire ratio analysis is also completed. Okay. So all the questions are done. And tomorrow, now we'll be starting with the next chapter, and that will be your leverages. So we'll be starting with a new chapter tomorrow. I hope you all have understood this. Okay. So I'll see you guys tomorrow with the same. Just practice that question once. Okay. And tomorrow, with the help of the new chapter, let's see uh, how leverage is one of the most interesting chapters, very easy. And Institute always asks a question on leverage. So you'll always love that particular chapter to be. Okay. So that's it from my end, my dear students. Just go through that video once again and check that particular solution also and solve it on your own. That's it. Bye, guys. Take care. See you. Bye.